in this market today, right, it can feel very volatile, especially the US market has been booming for so long, for more than a decade now. And even after the drop last year, just a short while, and then it recovers. And there's this feeling that, are we really in a bubble? Because things are, it's not really looking any better. Actually, things are looking quite dim, but yet the stock market keep booming. And there's starting to have a mismatch, right? The Asian market really lagging behind, not doing that well. And then now with China crackdown, even more fear in the market, in the Asian market, but yet the US market continued to boom. So what are we looking at? Are we really in a bubble? But I feel if we start asking this question, like, are we in a bubble? Are we in a bubble? It's a dangerous cycle. It's a dangerous cycle because we will fall into the trap that we are constantly trying to time the market, right? We're always looking, should I sell now? Should I buy now? Are we in the bubble? Should I be at the sideline? And it is the hardest thing to time the market. You can time it maybe one time, this time is correct, but what about the next time? If you start asking this question, you're going to start asking this question every single day when you open your portfolio or when you open the news. And it's a never-ending cycle. And if we do that for the next 10 years, right, most likely we're going to make more mistake than correct prediction. There is a lot of myth surrounding valuation, because when we see the professional, especially when we read brokerage report, wow, they look so professional, and they, with their discounted cash flow table so long, so accurate to the decimal point, right? Say this company is going to worth $15.64, and that's why it is 14.5% undervalued from our valuation. Yeah. So it's so deep to the numbers.
So precise,
and,
right?
Yeah, so precise. Looks so scientific, but actually that's not really true, because valuation is really a combination of art and science. And I actually feel valuation is more of an art and a skill that we can learn, and not so much a science. And we have to be careful, right? Every time either the company give us their valuation, or when we read at a report of evaluation, sometimes they like to mix up the valuation to the point that it looks good for them. We should be more careful with that. And valuation is really a quite an easy skill to learn. I wouldn't say it's an easy skill to perfect, because I think there is no such thing as a perfect valuation, but it's definitely a skill that most of us can learn. Personally, after investing for so long, I feel that in investing, valuation is not even the most important aspect of investing. Only in this part, when I decide if I want to invest in them, I'll do a valuation to see if the valuation is still okay for me to stomach, and I'll only make the decision here, right? I don't go and screen for stock based on valuation. I believe that there's still a large group of investors who prefer that say, I only screen for, say, stocks that is very, very cheap PE or very, very cheap price to book. And they start from there. They look into valuation first and then choose the company, which I feel this process has a problem, mainly because of the issue that I talked about, which is quality. We always want to find companies of higher quality because we want to stay in the game. We want to make sure that the company that we invest in don't die so easily in the market. And this is basically how I feel about valuation versus quality. If the company is very, very high quality, I put less emphasis on its valuation.